Good afternoon. My name is Kash Pashootan. I'm the founder and CEO of Emblem Developments. Today, we wanted to talk to you about what we call the opportunity. In 2 weeks' time, we're going to have a broker presentation and go through all the details of the building, the floor plans, the amenities, the finishes, all of that good stuff. But today, we wanted to focus on really the numbers, the math, and an opportunity that we've seen internally now, which in our view sets the stage for pre-construction condominiums to be more opportunistic now than ever before. Let me tell you a little bit more. As many of you know, my background, I've spent the last 25 years managing assets for wealthy families. We spend a lot of our time uncovering opportunities in different asset classes, stocks, bonds, real estate. And what we've been seeing is the perfect storm for what we call the great rotation, capital leaving stocks and bonds and going into alternative assets such as real estate. When you look at this chart, you can see that since 2009, the stock market has steadily risen higher and higher and higher, as seen by the black line. Today, investors are nervous more than ever that the stock market is nearing a crash. They're concerned that we're right around the corner, we're going to see some sort of meaningful decline, given that we just haven't seen that yet for 10 plus years. These are investors that often would not consider investing in pre-construction. They would not consider buying real estate. They were happy having their assets in stocks and bonds with their financial advisor. And today they're now looking for a new home for this capital to go to. They're looking for a way to pursue growth, but reduce risk, reduce their exposure to the stock market. And part of that is the most important part of this chart, which is what's happened from 1996 to 2009. If you look at the black line from 96 to 2009, what you'll notice is essentially the stock market over 13 years finished exactly where it started. If you invested $1 million in the stock market in 1996, it was worth about $1 million in 2009. Nobody is happy with a zero rate of return, especially over a 13-year period. And although no one can predict when the next lost decade will be, history teaches us, shows us that generally this happens after a prolonged period of escalation in share price. And this is exactly the environment that we're in now. So where do investors go? Well, naturally, they look at the bonds asset class because their financial planner or advisor will provide them with access to investments that will be generally focused between stocks and bonds. Unfortunately for investors, bonds don't solve the problem either. The light gray line shows you bond yields over the last 20 years. As you can see, bond yields have consistently come lower and lower. Today, you're seeing some of the lowest yields in bonds we've ever seen. You're lucky if you lock your money in for 5 years and can earn more than 2% in bonds. So investors are nervous about stocks. Bonds don't solve the problem. And so a lot of those investors that were not interested in looking at pre-construction, today they're opening to having a conversation. We think the market of investment buyers in real estate and pre-construction condominiums is larger today than it's ever been before. We believe the narrative, the investment thesis in real estate, pre-construction real estate today is more compelling than ever, because a lot of the investors that were not willing to listen are exactly those that are looking for a new home to put their capital. And we believe success in terms of real estate professionals, brokers, agents will come from those that sell through education, educating the client, because these investors are used to spreadsheets, they're used to charts, they're used to math. And they're looking for a place for this capital to go. And we call this the great rotation. And when you're talking to your clients about the great rotation of capital moving out of stocks and bonds, it's not just your view. And when we're sharing it with you, it's not just our view. It's actually a lot bigger than that. It's a lot bigger than us. When you look at the smart money, which we refer to as pension funds, they've been doing this for the last 2 decades. The chart that you're looking at shows you exposure to alternatives where you can find residential real estate as part of the overall assets of US pension plans. In the early 2000s, it was about 11% of overall assets. It has grown by 400% over the last 2 decades to today being about 40% of overall assets of US pension plans. What's most noteworthy is not the 40%, it's the momentum that that asset class has. It's the momentum of the great rotation out of stocks and bonds and into alternative assets such as real estate. We forecast that in the next 3 years, over 60% of US pension assets will be in alternative assets such as residential real estate. And this is not just the United States. It's not unique just to the US. This is a global phenomenon. This is happening consistently across all major pension plans on a global basis. In fact, right here at home in Canada, we see the same thing. In Canada, our largest pension plan, known as CPP, today has 57% of its assets in alternatives. Historically, we've seen pension funds lead the way. Whether it's moving from one asset class to another, moving from one sector to the other, generally, years after, private investors, retail investors follow suit. And this, in our view, is the biggest opportunity that's on deck right now that nobody's talking about. And our background in investment management and uncovering opportunities in all asset classes informs us of this. And this is what we're here to share with you today. In regards to the great rotation of assets leaving stocks and bonds and going to, for example, residential real estate, especially in the form of pre-construction. And we say pre-construction because there are a lot of parallels to investing in pre-construction as there are investing in a stock, in a company. And so what does that landscape look like? Well, we would describe the GTA housing market, especially within condominiums, as strong and resilient. And there's a few data points that really sort of drive this message home. As you may know, vacancy rates in the GTA are less than 1%. And yes, when you read the Globe and Mail or you look at the National Post, it'll say vacancy rates have doubled from 0.45 to 0.9. Yes, they've doubled, but still less than 1%. And in the submarkets, they're even lower, closer to 0.5. Internally, we refer to a vacancy rate of 0.5 as a housing crisis. There's a serious shortage of the number of units that are coming online per year. And the fact is, it doesn't matter how many more developers there are. There's simply not the labor out there. As developers, we're all fighting for labor with the same pool of trades that are out there. So there will be no long-term meaningful increase in supply. Yes, there might be a bottleneck here or there where more units come to market, but we're talking about the next 5-10 years. And we feel that the supply shortage and the increase in demand will continue. And we know a lot of this demand is coming from immigration. On average, Canada has about 240,000 new immigrants come every year. And yes, COVID has put a pause on this. But as you may have seen, the government is rolling out an immigration stimulus program to attract 400,000 new immigrants per year for the next 3 years. So the catalyst, the driver to demand and pushing prices higher being immigration, not only is it coming back, it's coming back in a more robust manner than we even saw it before. And in terms of an asset class, despite the pandemic and everything we read in the paper, the fact is condominiums on average appreciated over 8% last year. In most asset classes, an 8% appreciation on average is an excellent year. It's a great return. When you look at the stock market over the last 50 years, the average return was 7.5%. So for average prices to go up by 8% in a year of a pandemic, it speaks to how resilient the market is. It speaks to how strong our market is. And I know it feels expensive because compared to 2 years ago, it is expensive. And compared to 4 years ago, it's very expensive. But the fact is, when you look at Toronto, the GTA, compared to other major centers on a global basis, Toronto continues to be one of the most affordable. So the same way that it felt expensive 2 years ago and it became more expensive, we strongly believe it will continue to become more and more expensive for it to catch up on a global basis to other major centers. So when you look at this, you really see there's a perfect storm brewing. We have a rotation, we call it a great rotation, from stocks and bonds into pre-construction, into real estate as a whole. You have a market that welcomes it, that justifies it with its strength and its resilience. And all of this is happening at a time where we've seen some of the lowest interest rates in our lifetime. And we know when we look at different asset classes and different markets that they're not all created equally. So as compelling as the residential real estate market is, and as much opportunity as we see in pre-construction, we see specific opportunities that really stand out above other submarkets within this asset class. And for us at Emblem, we're active. We have developments all over Ontario. As you may know, we have 4 buildings under construction in Ottawa currently. We have projects in Hamilton, in Mississauga, in downtown Toronto, in Leaside, and in all of these markets that we're active in, where do we see the greatest opportunity? For us, we actually see the greatest price appreciation, the greatest opportunity in Hamilton. And the reason for that, well, there's a variety of reasons, but the main reason is very simple. It's government intervention. Anytime the government gets involved in stimulating price appreciation in any asset class, it puts it on an unlevel playing field. It makes that asset class, it makes that market not play by the same rules of price appreciation as other markets around it. As you may know, Hamilton is receiving an investment of $500 million to redo its downtown core. $500 million is a lot of money in any market, yet alone in Hamilton, which doesn't have a huge footprint. In addition to that, Hamilton is receiving $140 million to redo their waterfront. We're talking about almost $750 million going into Hamilton. This is like steroids. This is stimulus that we've seen in other asset classes, and we saw what happens. The bond market isn't doing well. People are not buying bonds. The government steps in, starts buying bonds. The price of bonds go up. The economy's struggling. The stock market's sluggish. The government steps in, stimulates the stock market. Stock prices go up. There is no other sub-market in the GTA that we could point our finger on that is receiving the same velocity, the same quantity of government cash. And for this, we feel that Hamilton, for the next 5+ years, will be on an unlevel playing field as other up-and-coming submarkets in the GTA. We're starting to see some of that in the numbers already. Prices were up about 15% last year. Rents were up about 15% last year. But again, we're very early days here. And we believe that the capital that's going in from the government will create an outcome that's going to be much more accelerated than what we would typically define as an up-and-coming neighborhood. You all know from experience that generally when 2, 3, 4 developers get together and redevelop an area, that's when great communities are established. That's when you see price appreciation from buying in early. That's happening in Hamilton. But when you combine that with the government capital to the significance of the dollar figures that are being invested, it puts it on an unlevel playing field. So when you put everything we've talked about together, you can see that there's a significant opportunity right now. It's a perfect storm. You have the great rotation of assets coming from stocks and bonds, going into alternative assets. We feel a lot of that will go into pre-construction condominiums because of their similarities to buying stocks. You have a housing market that shows strength and resilience with low vacancy rate, still being affordable on a global basis with the lowest interest rates we've ever seen. And you hone in on specific markets like Hamilton that provide distinct advantages that are not found in other submarkets. So the fact is, as a developer, we could come to market with a very simple building and everyone involved would do just fine. Your clients would do well, your investors would do well, you would do well, and us as a developer, we would do well. It's just simply not who we are at Emblem, though. The fact is, we've made it very clear. We want to raise a new standard. We want to set a new standard in any market, in any community that we go into. And we're going to do just that with One Jarvis. The building that we're bringing to market is the highest standard of residential living yet seen in Hamilton. It starts from the outside of the building and goes all the way inside. You will not find an ounce of stucco on this building. Brick, stone, glass, materials that are generally found only in buildings with a much higher price point. And that quality extends all the way to the inside. Every unit will have European design kitchens. The backsplashes will not be tiled with grout marks. Full slab backsplashes that match the countertop, creating a complete seamless look when you look at it. When you walk into the showers, first of all, it won't be curtains, which is what you find often in new construction in Hamilton. It'll be glass, but more importantly, the glass will be thicker. It will not sit on a metal shoe. It'll give the appearance like it's floating. Again, details that have never been seen in the Hamilton market. You combine all of that with the fact that 100% of the units will have a balcony or a terrace and a price point in the mid 300s. And we truly believe One Jarvis is 2021's best investment. On that point, I just want to pause for a moment and talk about something that's very important to us here at Emblem, and that's partnership. In 25 years of being in business, a main driver to success has been partnerships. And we bring that mindset to everything we do at Emblem. When you look at an Emblem project, every facet of the project, we work with the best in the industry, whether it's the architect, the interior designer, the window manufacturer. We work with the best for every facet. And that extends to you, real estate professionals that will be articulating our brand, educating your buyers, your clients, and essentially selling these buildings. We are interested in forming partnerships that are quality over quantity. For us, it's about a lot more than One Jarvis. As I stand here and speak to you today, I can say that Emblem has one of the most active pipelines of any developer in the GTA. Today, we have 24 months of sales launches already set. Let me share with you what we plan to partner with you on for the rest of 2021, because we have a lot of work to do. From One Jarvis, we're going to spin right into Artform 2. And some of you on the call helped sell units and we're a big part of Artform 1, and we want to say thank you. We're grateful for your efforts. Artform 2 will have a lot of the same attributes as Artform 1. The same standard finishes, the same access to the major transit hub. In fact, the building is 400 meters away from Artform 1. That will be coming out in spring. It will have over 400 units. And again, the same optimal unit mix that you saw with Artform 1, units that buyers are looking for today, will be present in Artform 2. From there, we will go to Leaside, a project we're very excited about. You will see two buildings that will be similar to the rendering. And they're strategically located across the street from the RioCan development that you may have heard about, which is going to attract some of the best dining, shopping, and entertainment that Leaside has seen in 50 years. From there, we go back to high rise, downtown Toronto, King Street East, 40 levels. And we're very excited to unveil who we're collaborating with to design this building. The first time they're coming to Canada, and we're proud to be the ones bringing them. As you can see, we have an active pipeline for the rest of this year. We thought we'd stop there and not get into 2022. But based on that, I just want to say thank you. Thank you for your loyalty. Thank you for your trust. Thank you for your partnership. We look forward to working hard together, and at the end of it, celebrating mutual success. Thank you. If there are any questions, I'd be happy to answer them.
Kash, thank you so much for giving us so much valuable content this evening. I'm already getting messages from our team about how helpful this session has been, and we're super excited about the launch for One Jarvis. If you're okay for time, do you have time for a few quick questions?
Yeah, I'd be happy to, sure.
Okay, perfect. So the first one is, being part of the reshaping of the neighborhood and owning quite a bit of land, what do you envision the completed community to look like? Because I think you mentioned you have a few more developments coming there as well.
Yeah, we have about 1 million square feet in addition to this that will be all residential. It'll be about a 5-minute walk from this site. So we're definitely interested in accelerating prices, because every launch that we have, of course, will do that. And our vision for the community, how we see Hamilton different than some of the other submarkets, is that we actually see Hamilton as having the potential, their downtown, to feel like downtown Toronto. Obviously not with the same financial sector or with the same height of towers, but when you come downtown Toronto, there's a real vibe, right? You see restaurants that there's only one location of, and the person that thought of the design is there every day running it. You're not seeing chains or franchises for the most part in the downtown core. There's a vibe to it. There's very cool spots. And when you look at some of the other suburb markets, for example, Mississauga, a market that we're very active in, it's different, right? If you go downtown Mississauga, you're going to be at Boston Pizza. And don't get me wrong, I love Boston Pizza, but it's a very different vibe. So the uniqueness that Hamilton has is that we're able to really build it from the ground up. And it's not going to be necessarily focused just on families. It's going to attract young professionals, younger couples, younger families, but people that are looking for something that's more distinct and has a bit more edge, a bit more personality. So we envision downtown Hamilton to becoming a real destination spot because of the vibe that exists and what it will attract in terms of dining, shopping, entertainment. And that's how I see it being different than some of the suburb markets. When you look at the downtown core of most suburb markets, even if they're very well established, they will always feel like they're a little safer or a little bit more conservative than the downtown core of an area like Toronto. But I think given Hamilton's edge, there's the opportunity to achieve that real distinction and that real vibe based on its personality. So that's what we're looking at accomplishing there. And we're planning on doing that with the commercial spaces that exist in our residential developments. So we're very excited about that.
Awesome. And Kash, you mentioned the $140 million redevelopment of the waterfront and a brand new $500 million entertainment hub coming to Hamilton.
Yes.
Are those projects that the city has already confirmed and allocated funds for, or are they still in the planning stage?
No, they're confirmed. They're confirmed, yeah.
Got it. And another question that came in, Hamilton has had one of the strongest rental markets in the country over the past few years with annual increases of 15%. In your opinion, what are the top reasons that set Hamilton apart from some of the other outlier cities within the GTA?
I think it's a great question. For us being very investment focused, the answer to this question is exactly why we see price appreciation of the condominiums being more profitable, more opportunistic there than a lot of other markets. And the reason is you're starting at such a low level, right? When everything is based on valuation. For example, in the stock market, if you look at two companies, and one company is a phenomenal company, and the second company is a good company, everyone thinks the phenomenal company is going to appreciate more. But everything is based on the valuation. What are you paying for that asset? So in the market, the company that's just okay or good, let's say, compared to the phenomenal company that everyone knows, may have actually more upside appreciation because at this stage, that's not priced in yet. And that's how we see Hamilton. The fact that it's starting at such affordable rates from rents to price to buy, we see more upside potential. I actually think there's a higher probability of seeing $200 appreciation per foot in Hamilton than I do downtown Toronto. Because downtown Toronto, when you think about it, what is it going to take for it to go up another $200 per foot? It's kind of hard. You're stretching to get there. But Hamilton is so at its early days that we see a clear path to that appreciation. And the fact is, given that it's almost half price per square foot as downtown Toronto, $200 would mean on an IRR basis, it's a much higher percentage return, right? So the fact that rents have started to go up and prices have started to go up is a sign to us that it's really in that sweet spot. You're not too early where you're waiting for it. It's not 2 years away from being 2 years away. And you're not sort of so into it that a lot of the juice has already been squeezed out of the fruit. So we see it as in the early days, and we see significant upside potential in terms of rents and prices as well. And one sort of interesting point to mention is when you look at art form, for example, We're doing exactly the same building here, right? Even though price per square foot is less and revenues are less, we're not cutting any corners. We're not value engineering the building. It's the same finishes on the outside, the same standard finishes on the inside. The difference is, you can say to your buyers, look, this building sold almost 90% in 3 months. That's how strong demand there is for that product. You're able to buy exactly that same product for $200 less a foot. So buyers can see a path to how their investment is going to appreciate. Where I find in other markets, sometimes it's hard to see that path so clearly as how it goes higher from here. But Hamilton is just starting on that path.
Right. So the next question is one of the most recent stats, you kind of touched on this, but one of the most recent stats we heard was the average sales price being up 13% in that area year over year. Where do you see Hamilton in the next 5 to 10 years from a pricing perspective?
Yeah, so look, I think the first milestone in pricing for Hamilton is to get to where Mississauga is. Because again, there's similarities. They're both suburb markets. Distance-wise, they're not that much different to downtown. When you're on public transit, if you sit on the bus or the train for an extra 8 minutes, 9 minutes, it's not a game changer. So we see the first major milestone for prices to appreciate to represent similar to where Mississauga condo prices are. And we see that in the next 5 years, absolutely. I mean, I actually think it can happen more quickly than that, depending on what sort of commercial and entertainment and shopping is attracted to the area. But I would say to see $200 plus price per foot appreciation over the next 3-4 years makes a lot of sense to us.
Amazing. That's great. The next question we have here, there was a condo in the area which was recently canceled as a result of issues that came up while going through the rezoning and city approval process. What are you doing differently to ensure that that doesn't happen here?
Yeah, it's a great question, and I'm glad you're asking it. So there's a couple of things. Number one, this project's already zoned. Terrion's already in place. We can literally sign deals today. So we don't bring anything to market unless it's ready to go, because we place too much emphasis on our reputation. It's just the way we do things. It's our DNA. That's our code. So there's no risk of that happening. The other side of risk, I would say, and we're all aware of this, is what is the developer's capability to actually execute?
Right.
As we've talked about before, one of the unique advantages of Emblem is we are one of the best capitalized developers in all of Toronto. We have more liquid capital than developers that have been around for 30 years. We don't raise capital, right? Today, Emblem has access to close to $1 billion of Canadian currency. And that's because it's backed by First Avenue, a firm that I founded and I've been managing for over 20 years. So for us, this is very important, especially, we forget to talk about it, but, I go back to when we were launching Artform, right? When we were planning on the sales launch of Artform, it was really February, March of last year as we started really talking about it. And if you recall, that was really the peak of the virus, right? The pandemic. We had no idea what was going to happen, how deadly it was. We didn't know that, it had a very low death rate. We had no idea what it was. So what we were talking about doing was that if the situation became worse, we would actually bypass sales. We would start construction through our own balance sheet. We don't need financing to build this building. We could build it with our own balance sheet. And again, that's very unique. So luckily or fortunately, the market came back and it was strong and we launched and reached our sales threshold pretty quickly. But we would have started construction. I mean, if you drive by Artform right now, it's under construction. We were going to go and start construction, rain or shine. There are not many developers. In fact, I don't know of a scenario where a developer in Toronto actually started construction without launching sales. So we were ready to do that, and we're ready to do that here as well. And I think that's very important. So buyers can have the assurance that we can self-perform the financing and actually build this building without a lender. Obviously, with Emblem's strong covenant, we will take advantage of cheap money with low rates. But the fact is, we have the ability, the capability, we have the capital to be able to self-perform. So I would say two things. One, there's no zoning risk here because the project is zoned. Terrion's in place. The second is our capital structure and the financial backing of Emblem by First Avenue. The one last thing I'll say on risk is we all know how important Terrion is. and in the role that it plays in protecting buyers from developers. What some people don't know is Tarion has 3 levels of risk ratings for developers. And it's really based on 2 things. One is the experience, the depth of team you have. And the second is your financial positioning, your financial strength, your financial covenant. And so what will happen is with each project, Tarion will require the developer to put a bond or a deposit per unit of that building. And it starts at $40,000 per unit. That's the entry level deposit required. As you go down in Tarion's eyes of risk profile, that $40,000 turns to $30,000 per unit. And this is where a lot of developers sit. The one level lower, which is the least level of risk in Tarion's eyes, is $20,000, per unit. The $20,000 per unit is their lowest risk rating. This is where Emblem is. Emblem, we're talking about our financial position and our ability to execute, but it's not based on what we're seeing. Tarion views it the same way as us having the lowest deposit required based on our risk rating. And that was present in our form and continues to be present in One Jarvis.
Amazing. Next question here. With development charges significantly lower than other areas in the GTA, can we expect to see low caps as a buyer incentive in the platinum stage?
Yeah, so look, in 2 weeks, we're going to roll out the entire package, prices, charges, assignment, floor plans, everything will be there. And what I can say today is that the same way when we rolled out our form, that I believe it was very well thought out and very competitive. Our promise is that as a package, all facets will be really considered and they will be very competitive. So whatever we can do, we will do. And I assure you that we're going to be coming to market with our pencil very sharp.
Amazing. Do you foresee any potential large delays to construction as a result to further COVID-19 restrictions being placed on the Canadian economy?
No, I mean, look, construction's going on right now, right? Like we have, right now we have 5 active sites. They haven't been delayed because of COVID. The fact is no one really knows if the situation gets really bad, then that's something that we will all face. It will not be unique to our projects. But, we all know there's some good news in sight. I mean, the vaccine is here. We didn't have a vaccine 6 months ago. So it is things, it seem like right now we're in a pretty tough spot, right, with winter and with the lockdown. But again, all of this is about 3 years from now, right? And we all know that. I mean, the investments we're making today are for 3 years from now. The life that we all live today is for what we did 3-4 years ago. So the decisions we're making now are for 3 years from now. And based on where we are with COVID-19 and the vaccine, we feel very confident that this will work out over the next 3 years. The other thing I would say is with this building, we're building essentially 3 of these, right? Our Form 1, our Form 2, and One Jarvis are going to have a very similar look and feel and standard. And SkyGrid, which is one of the top construction managers in Toronto, is contracted to do all of these 3 buildings. So there's going to be a lot of efficiencies and economies of scale because they're basically replicating the same thing 3 times over again. And so we don't see any delays that we can control. And that's why we have a 3-year time horizon on this project.
The quality of buildings that Emblem is developing seem to be of the quality that you could place in literally Yorkville and they would hold its own. How are you able to offer such high-end finishes and details when Toronto developers aren't offering them when selling for even double the price per square foot?
Yeah. So yeah, it's a good point. I mean, look, the short answer is we're in this for the long haul, right? We are looking at building a reputation that creates distinction compared to what other people are doing. And the way you do that is you have to be different. You have to be different. And we're different in a few ways. One, with the capital structure we have and the financial backing we have. And the other is that we take a long-term view in everything that we do. So you're right. I mean, the fact is we could have, as I said earlier, we could have built this building at a much lower standard and no one would have complained because, Hamilton's up and coming. We've gone over the top. And so we're able to say this is the highest standard. And look, I'll tell you, we're going to do this in every building, right? Not only here, but in Leaside, when we come downtown Toronto for our King Street East project, when we unveil who we're collaborating with there, it's phenomenal. It's very exciting. And so we're doing this because we're very passionate about it. We're not just looking to build buildings. And the irony of it is we're so numbers driven, given our money management background, but the creative side is so strong as well, I know for myself. And so we put that together and we really have a long-term view. So you're right. I mean, the standard finishes, what we did in art form, projects, they've never seen that before at that price point. So we really take seriously what we build and we take pride in it, and we want it to look really good. I mean, the Yorkville example is interesting. We've heard that a few times, that it looks like a building that should be in Yorkville. And I'm glad that buyers in the market sees it, because we've made the bet that people can tell the difference between average and not average, or builders that are just doing it to do it, and people that are really passionate about design and all of that. So I'm glad that's coming out. And our goal, and what we're already hearing some buzz about, is that Emblem buildings will trade at a premium in the resale market, right? And if we start to build that reputation, which we're on the road of doing, for real estate professionals like yourself and your teams, it's going to make every launch we have that much easier, right? Because investors, buyers will know that investment is going to trade at a premium because of the quality that they get, because of the fact that we don't value engineer or cut corners, because we're looking at this as a 50-year game as opposed to what's happening over the next 5 or 10 years.
Great. Can you provide any indication about the suite type mix and the average price per square foot that our clients can anticipate?
Yeah, so what I could say is when we launched Artform, and I bring up Artform because there's a lot of similarities, and it worked really well. So we want to take the DNA of that project and why it was a success and bring it here with one Jarvis. But I think what made Artform really successful is that the unit mix was optimized, right? You guys know with projects, sometimes you get into a project and after the first 50 units sell, the rest of the building is pretty challenging. Either the units are really large or it's broken up floor plans. When we did Artform, we had 58 renditions of each of the different suite mixes. And so we obsessed, and we made it very clear. If you look at our floor plans, there's very little allocation to hallway space because no one relaxes in their hallway. We really want to make all of the square footage as usable as possible. So we make our life more difficult, but the truth is we love it. I mean, we're very passionate about it. In terms of unit mix here, we're going to do a lot of the same things. So for example, in Artform, we did the 1 bedroom plus den instead of just doing 1 bedrooms. We're going to focus on that as well. Because again, whether you're buying it to live, pardon?
So no 1 bedrooms in the building?
We're going to launch all of that, Sarah, on 2 weeks from now. But we will focus on, the focus will be 1 plus den. But look, if you're able to buy 1 plus den at a price less than a 1 bedroom, I think, again, that's where the value comes in. The other thing that we did that we found was successful was instead of the traditional 1 bedroom plus den and 1 bath, we had a lot in the way of 1 plus den with 2 baths. And that made the project really stand out from what some others were doing. So we really do take the time to look at how do we optimize the suite mix and make sure we come to market with something that buyers are looking for. And you'll see that here as well. So the unit mix, I have no issues. I have no doubts that it will sell very well because over 80% of the units, I can't give the number today, but will be very, very affordable. It's not a situation where you're going to sell a third of the building and the 2/3 are going to be challenging. And price per square foot, without getting into too much detail today, because like I said, we're going to unveil all that 2 weeks from now, expect it to be about $200 less per foot than Artform.
Amazing. Anticipated closing date? Any idea yet?
Yeah, 3 years from now.
3 years from now. And any indication of the ratio of parking to the number of units?
There's going to be, so there's going to be a healthy amount of parking. There's going to be lots of parking. But the fact is this building and where Hamilton is and where it's going, it's designed to be a very downtown sort of product, right? So the fact that it's right in the heart of where the $500 million investment is going, you're going to never have to leave this location because you'll have the best shopping, the best dining, the best entertainment. But if you do need to leave, it's 4 minutes to the Hamilton Go. So we will have parking, but I actually personally believe that you don't really need to buy it with parking, but there will be lots there and we need to sell it. So it'll be available.
There's just one last question. Is there going to be any commercial and retail at the bottom of the building? And if so, what type of retail do you anticipate being there?
So there will be retail, and one of the conversations, because again, I think it comes out that we are very obsessed with our brand and guarded and protected. So one of the things we were doing, and we put those conversations on hold, but we have 3 years to figure it out. We were talking to a couple of Toronto restaurateurs before, and we are also for Art Forum, because we want to create a cool vibe. We want to create a community where it's not just a great building and then you have, something on the retail that's very sort of wah, right? Like very subpar. We want it to be a whole package. And so the commercial will be sort of a restaurant style, bistro style vibe to it as we envision it. But there's some options there. One thing it won't be is some sort of entry level or something that's not appealing to the users. We're not interested in that, and that's really not part of the community. So we will consider selling the commercial, but the fact is that we're in a position where we can just sit on it and we don't need to move on it. So we will wait for the right tenant, because at the end of the day, that's a big part of the overall brand of the building.
Right. I think that's the end of the questions. Kash, thank you so much for giving us so much valuable information this evening. It was truly a pleasure and honor to speak with you today. And we really believe this is going to be one of the best pre-construction opportunities in 2021. We're really looking forward to working with you and your team on this project, and let's get it.
Thanks, Sarah. We appreciate it. We're looking forward to it as well. Take care.
Thank you. Bye. Take care.